Okay, so I thought it was easier to probably answer this question via a little video rather than to type out a whole long story on Twitter, right? So you ask a couple of questions. So this is obviously for YT Trend Trader on Twitter at Trend Trader JSE. That basically asked. So you were asking questions today around, can you trade 100% margin CFDs? So the answer to that is technically no. Not that I know of. I don't know of any providers that will make a CFD but ask for 100% margin. There are obviously times where 100% margin is required on a particular CFD. For example, Steinhoff. Now you wouldn't get new CFDs written on Steinhoff, but when Steinhoff was busy like crashing and collapsing and all that stuff, and even during the March crash, margin rates on certain CFDs would be pushed up, some to 100%, right? Sasol, I think, was at 80% at one point. Just because, the CFD writers, in this case, the banks, are trying to manage risk. This, of course, is provided you're trading DMA CFDs and not OTC CFDs. So lots of different things there. I'm hoping that you understand a whole bunch of them already. If you don't, ask more, and I'll probably end up making more of these to try and answer them. In any case, so to get to the answer that you were looking for, you said, so okay, cool. You might have misunderstood the leverage part. So with easy equities, it's equity, not CFD. Sure, yes. And you pay the full price for the share. Yes, no leverage, full price for one share. But leverage CFDs, you pay a fraction of the price, say 10%. Okay, so correct. So the different trading sort of platforms and accounts and stuff that we offer, obviously, give you the option to trade either CFD or equity. If you trade equity, that's the normal underlying share known as vanilla equity. If it costs 140 Rand a share, you must pay 140 Rand for that share. There's no margin deposits. It's 100% cash you must pay. The advantage of this is obviously there's no funding rate. You get the three sort of claims or rights that come with being a shareholder. One, you are a legitimate shareholder in the company. You have a perpetual claim over that share, which means you can give it to your grandkids and all sorts of stuff. You also have a right to earnings and a right to vote, right? So you're a real deal shareholder because you paid full price for the share. The disadvantages are that you pay a slightly higher brokerage rate, not necessarily because the brokerage is higher, but because you have to cover this securities transfer tax, which is pretty high, as well as other fees like straight and levies and all sorts of settlement charges and whatever. So in general, it's a bit more expensive to buy or to trade in than what a CFD would be, but obviously you don't use gearing. When it comes to CFD, a lot of those fees, like securities transfer tax and that kind of stuff, drop away. That's why the brokerage rates on CFDs is generally lower, because you're not actually buying the underlying share. The bank's doing it on their balance sheet, in the case with Terenia at least, and then they underwrite that contract for difference to you, and then charge you interest on the difference between the margin deposit and the value of the contract, right? So, or the nominal exposure of the contract. So what happens is, whether you buy a CFD, let's say, for example, and different stocks will have different margin rates, right? So, something that's very liquid might have only need 7% margin deposit. Something that's slightly less liquid might need 12%. Something that's like very illiquid might need 50%, right? So it depends on the actual underlying stock itself, number one. Number two, the volatility and the associated risk that the bank may or may not have to take in order to be able to, I suppose, protect themselves is the answer, or the word I'm looking for. But so what happens is, let's assume for the purposes of example, margin deposit is only 10%. So let's say you've got 10,000 Rand in your account, and you want to buy 10,000 Rands worth of stock. Now you've got two choices. And let's assume, for the sake of example, brokerage rate is 0. So let's exclude brokerage from all this stuff, right? So you've got 10,000 Rand and you want to buy 10,000 Rands worth of shares. If you buy shares for 10,000 Rand, normal vanilla equity shares, you buy them, you hold them, you pay the full amount of the value of those shares, which is 10,000 Rand. and you've got zero available cash in your account because all of it has been exchanged for shares, and you now own a part of that company. If you want to buy 10,000 rands worth of CFDs on that share, you would buy the same amount of shares, obviously, except now you would put a 10% deposit down, and you would sit with 9,000 rand in cash, 1,000 rand in sort of margin deposit, and 10,000 rands worth of exposure to the share that you have. So now in this scenario, you're going to be paying interest on the 10,000 rand that you're financing, right? The position that you're financing. You've got 1,000 rand margin down, but at the same time, you're still earning interest on the 9,000 rand cash that you have in your account, as well as the 1,000 rand that's on margin deposit. So you're earning interest on 10 grand at, I think it's 1.43% or whatever the credit rate in some of these trading accounts are at the moment, depending on how much you have. You put 50 million rand in an account, will give you better interest rate, I promise you. If you if you do 50,000 rand or whatever, it's like 1.43%. And the margin and the sort of funding rate is coming in at around 7%, right? So you're kind of still paying a net of 6% interest to hold this position, as where if you bought the straight vanilla equity, you would obviously pay no interest. So if you want to hold the positions for longer periods of time, obviously equity is better because you don't pay interest. If you're going to be doing short-term trading, then the CFD is probably a better option, simply because the brokerage rate is so much lower that it kind of offsets the interest components if you're only holding trades for a couple of days or to a couple of weeks at a time. But you've got the odd short position and this and that and whatever in there. It sort of doesn't really make too much of a difference, unless of course you take a position and you hold it for the next 6 months. You're gonna bleed a lot in interest. You're gonna lose like 3.5% of your investment just on interest over a 6-month period. So that's not necessarily wise to do. So I don't know if that answers the question, because you were looking at I hope that answers your question. I mean, let me know if it doesn't. You say of the full price, but you get full CFD. But if you want to pay 100% margin of funding the broker for one full CFD, then and if you want to pay 100% margin, then there's no there's no reason to use a CFD. Then you just use an equity, right? Then you buy the actual share. You don't have to then buy a derivative of that share or a contract for the difference of the share. So just to explain, a CFD stands for contract for difference, right? So instead of buying the share with your own money, you give the bank a deposit, or in this case, Harenia obviously uses various trading service providers and banks to do the trading through. So you basically say, I want to buy 10,000 rands worth of shares. Here's a deposit for the share, which is 10%, 1,000 bucks, and then I will buy 10,000 rands worth of shares, and I will then profit or lose as the value of the full 10,000 rand. A number of shares, as the value of that changes up and down, I will make that profit or loss because I bought this contract from the bank, right? And the bank sits with the shares and then charges you interest for holding the shares. So they've got almost zero risk. One, because they've got enough money to buy all this stuff. Two, they're hedged 1-for-1. And three, they're charging you interest. It's a lending deal, basically. And they've got margin deposits, so if the position goes against you, they can close you out, and they know that, okay, cool, their risk is covered, right? Of course, the risk is that the market moves really quickly and blows up, your account blows up, and you lose more than you have, and then they can't recover the cash, and this is why they dynamically increase and decrease margin deposit requirements depending on different market conditions, right? So that is a contract for difference. It's basically a derivative that you trade on the share. So if you have, for example, 10,000 rand in your account and you want to trade with 100,000 rand, you can, because you can gear your 10,000 rand 10 times to buy 100,000 rands worth of stock, which is obviously insanely risky and probably very stupid, and I would not recommend it. But it is possible, right? So if you want to trade a CFD at lower cost and you've got 10,000 rand, for example, and you only want to make sure that you never have more than 10,000 rands worth of stock, you will only use 10% of the cash in your account. The rest will sit there earning interest, but it doesn't mean that that you have to use it. Like, you can easily, like, if you've got a 100k account and you never want to take more than 100,000 rands worth of exposure, fine, that's responsible trading, right? If you want to not pay interest and you say, well, look, I want to do 100% margin, I mean, you may as well just buy the normal stock. Yes, it's a little bit more expensive, but given the fact that you want to hold it for a long period of time, the extra 0.2% that you pay on brokerage hardly makes a difference in 10 years from now, right? If you compare that to the interest component that you're going to pay every year, even if interest rates drop really, really low, it still doesn't make sense to pay interest on a long-term investment, right? So yeah, I think that I hope that answers your question. I think if you have more, please let me know, and we'll be very happy to help and answer them and all that kind of cool stuff.